Right, let's go ahead. Hello and welcome to the second in a two-part series on recent tax proposals from the Biden administration and congressional Democrats. Today, we're going to focus on corporate tax proposals. I'm your host, Will McBride, Vice President of Federal Tax and Economic Policy at the Tax Foundation. I'm joined today by Erica York, economist of the Tax Foundation. Erica will discuss the major corporate tax proposals that we've seen from the Biden administration, the Senate Finance Committee, and most recently, the House Ways and Means Committee. We've all been staying up late into the night trying to sort through hundreds of pages of legislative text from the Ways and Means Committee. So we appreciate Erica's expertise in making sense of it all. Also joining us today is Doug Holtz-Eakin. Doug's the, for those who don't already know, the former CBO director and president currently of the American Action Forum. Doug will give us his impression of the various corporate tax proposals and put it into the context of the larger debate over the federal budget. Before we start, two housekeeping items. This webinar is being recorded and will be available on our website for later viewing. All attendees are muted, but feel free to ask questions using the button at the bottom of the banner that says Q&A. If you do ask a question, please include your name and organization and the panelist for which the question is directed. And with that, I'm going to hand it straight over to Erica so she can get into the complexity and the big picture as well on these corporate tax proposals. Go ahead, Erica.
Thanks, Will. So as Will mentioned, we've been spending the last several days guzzling coffee and poring over bill text so that we could produce estimates of the House Ways and Means Committee legislative text. So I'll go over three main points today. First, the similarities, differences, and unknowns between the proposals from the White House and the two chambers. Second, our brand new estimates of the Ways and Means plan and the corporate tax changes. And then third, the trade-offs of relying on corporate income taxes to fund new spending initiatives. On the corporate side, both the White House and Congress are considering an increase in the corporate tax rate, major expansions to tax credits for green energy and other policy goals, as well as major changes to the international tax system that would raise rates on both US multinational firms operating in foreign jurisdictions and foreign multinationals operating in the US. The administration has called for a 28% corporate tax rate and major overhaul of international taxes, such that those changes combined together account for about 2/3 of the total revenue that Biden's plan would raise. Biden has also proposed a minimum tax on the book income of large corporations, as well as other changes to the corporate tax code. Now, after this week, we've seen how the House Ways and Means Committee has put pen to paper, and we definitely see that the Biden administration proposals have had an influence here, but that they've been moderated somewhat. The corporate rate increase is scaled back to a top rate of 26.5%. The proposal includes $235 billion of expansions for green energy tax credits and changes to international taxes that are of the same theme, but don't go quite as far as the administration. For example, they would result in a tax rate on GILTI of 16.5%, calculate GILTI on a country-by-country basis, reduce the exemption for QBI to 5%, among other changes, and reduce the deduction for FDII to result in a tax rate of 20.7%, among other modifications to the international tax system. Missing from the House Ways and Means proposal, though, was any sort of book minimum tax. So we haven't seen that come up yet, but we did see the effective date for a tighter limit on executive compensation move forward as a revenue raiser. The Ways and Means Committee also included a delay in the requirement to amortize research and development expenses that would have taken effect after the end of this year, but is now delayed until after the end of 2025. Ways and Means also included so-called healthcare savings in their legislation, which is estimated to be about a $700 billion revenue raiser. That proposal would allow government set prices for certain prescription drugs under Medicare Part D, and those prices could also be used in private insurance markets, using the leverage of a very excessive excise tax on drug sales to get companies to comply with the government set prices. While that proposal would reduce government spending for prescription drugs, it would also reduce R&D and innovation within the pharmaceutical industry. It did not receive enough votes to advance out of committee, but it could be added back in before the package goes to the floor for consideration. So now we're waiting to see what changes come out of the House Rules Committee before the legislation goes to the floor, and then how much daylight exists between what the House settles on versus what the Senate Finance Committee is working on. For instance, we could see changes to the international provisions made in the House Rules Committee, perhaps unifying the rates on FDII and GILTI, or changing some elements of the international plan to look more like the Senate plan, and drug pricing provisions could be added back in as well. Over in the Senate, Senate Finance Chairman Wyden has released a bevy of proposals on a wide range of corporate tax elements, but several specific components of those, such as rates for corporations and within GILTI and other elements of the international system, have not been specified yet. And really what we find in our modeling is that it is the rates that drive a big part of the revenue implications of these changes. So there are still a lot of uncertainties as to what a final package will look like on the Senate side. And in one vein, we could see some proposals further moderated, such as paring back the corporate rate increase to 25%. But on the other hand, the international changes may end up looking closer to the White House plan that looks more like a true global minimum tax and a move back toward a worldwide system for international taxes. And that brings me to our estimates, our preliminary modeling of Chairman Neal's reconciliation tax package. We find that it would reduce after-tax incomes in the long run by 1.7% for the top 80% of taxpayers, while raising just over $1 trillion by 2031. Increased revenue would come with a trade-off of more than 300,000 fewer full-time equivalent jobs and a 0.98% lower long-run economic output, while falling short of fully funding all the priorities that lawmakers want to spend on in the reconciliation package. Within those estimates, the corporate rate increase and the international tax changes are the most economically harmful provisions. We find that they account for about a 0.7% reduction in long-term output, and that they would negatively impact those earning below $400,000. We find that all industries would face a tax increase on their foreign-derived profits, making them less competitive with foreign firms. And overall, the proposal would raise the average tax rate on domestic profits by more than the average tax rate on foreign profits, resulting in a net increase in profit shifting. So while politically the corporate and international taxes may appear to satisfy the pledge to not require households making under $400,000 to pay a penny more in taxes, analysis from our modeling, as well as those as other tax modelers, show that households across all income levels bear some of the burden of the corporate tax increase. For example, the Joint Committee on Taxation recently released estimates on the distribution of raising the corporate income tax to various levels. Their analysis didn't include the 26.5%, but they looked at a 25% rate and a 28% rate. And they find that in the first year, the burden of the corporate tax is allocated entirely to shareholders. That means that the burden is tilted toward the top, but even the JCT finds that households making below $200,000 per year bear some share of that tax increase, as they also have a stake in corporations. One example of how that happens is that everyday Americans own stock through their retirement accounts or their pensions, and so would be exposed to a corporate tax increase that way. Over time, the JCT finds that labor or workers bear a share of the corporate tax burden in the form of lower wages. And so by the end of the decade, in the JCT's estimates, households making under $200,000 bear an even larger share of the tax increase because it affects labor as well as their capital income. Another example of this, when looking at the impact of the entirety of President Biden's proposals, the Tax Policy Center estimated that when including the corporate income tax increases, most households would pay more in 2022. Specifically, they found that about 3/4 of middle-income households would face a tax increase averaging about $300, nearly all the result of the corporate income tax changes. Of course, the details of the Ways and Means Committee proposal and what the final package will look like will be different than the Biden proposal, but these estimates all show that the corporate income tax and international changes will burden households making below $400,000. And lastly, that brings me to my third point, which is the trade-offs in the Build Back Better approach of using corporate income taxes to finance new spending. Research from the OECD finds that corporate income taxes are among the most harmful ways for governments to raise revenue. And that's because in an increasingly global economy where capital can search for its next highest return, the corporate income tax becomes more distortive and more burdensome for workers as investments move elsewhere. Further research from Clemens Fust and others indicates that workers most affected by higher corporate income taxes tend to be lower skilled, young, and women, some of the very same people who are supposed to be helped by the Build Back Better agenda. While the administration and others cite a race to the bottom when it comes to corporate tax rates, the story is quite different. Since about the 1980s, statutory corporate tax rates have been reduced and clustered around the mid-20s, not zero, in part a recognition of the harmful trade-offs associated with the corporate income tax. Backing up just a little bit, the TCJA, or the 2017 tax law, brought the US statutory corporate tax rate down from a federal state combined rate of 30.9% in 2017, which was then the highest in the OECD, to 25.8% in 2020, slightly above the current OECD average, which when excluding the US sits at 23.4%. So currently we are by no means an outlier in terms of our corporate rate, where we're actually slightly above the middle of the pack. Under the Ways and Means text, the US would have an average federal state combined rate of 30.9%. Taking us back up towards the top, we would have the third highest rate in the OECD, behind only Colombia and Portugal. And the initial Biden administration proposal, which would raise the corporate tax to 28%, the US would have the highest combined rate in the OECD. Statutory corporate tax rates and international tax systems matter for a variety of factors. They matter for profit shifting incentives, as we discussed earlier, and they matter for competitiveness. Doubling down on flawed international designs and moving in the opposite direction of our peers means US companies would be disadvantaged relative to their foreign headquartered competitors. My colleague Daniel Bunn has used Tax Foundation's International Tax Competitive Index to capture the effect on the US tax system. So the index has been used to compare the tax systems of OECD countries since 2014. And it doesn't just look at corporate tax systems, it looks at the entirety of a country's tax system. So at that time, the United States ranked 28th out of 36 countries in the index. Following the 2017 tax reform, our rank improved dramatically to 20th, and the US now ranks 21st. And just a note, the index is not necessarily about how much revenue a country raises, but it's about the structure or the way in which a country raises its revenue. So under the legislation put forward by the Democratic members of the Ways and Means Committee, many of the 2017 reforms would be reversed, increasing burdens on businesses and workers. And from the standpoint of the index, the hikes envisioned by the House Democrats would push the US down the rankings to 28th place, tied for where we were prior to the 2017 tax reform. On corporate taxes, the US rank would fall from 19th to 30th. The trade-offs of these types of tax increases are to make the US a less attractive place for businesses and for workers. Competition is about designing tax systems in line with the goal of minimizing economic distortions while raising sufficient revenue in the context of a global economy where firms and workers can move across borders. The proposals coming out of the White House and Congress don't achieve those ideals. And I'll conclude there and pass it over to Doug for a discussion of the spending and the net effect of these proposals, looking at the bigger picture of the Build Back Better agenda.
Well, thank you, Erica, and thank you everyone for the chance to join you today. Let me just talk a little bit about the efficiency of these tax proposals. That is, how much do they interfere with the operation of the economy and the capacities to grow? Just remind everyone a little bit about the incidence, who really pays this, and the economic reality that is at odds with the rhetoric that no one under $400,000 bears any tax increase, and then close with the budgetary implications and the growth implications of the package as a whole. Let me pick up with where Erica left off and remind everyone that prior to the 2017 reforms, the US had the highest statutory corporate rate, and it had the only worldwide tax system left among developed countries. And what that meant was that our companies were taxed on the basis of their global earnings, whereas their competitors in, say, Germany were taxed only on the basis of what they earned in their territory in Germany or wherever else they're operating. In practical terms, that meant if a US firm and a German firm competed in Brazil, the German firm paid the Brazilian tax and was done. The US firm paid the Brazilian tax and then owed a second layer of tax up to the highest rate in the world back in the United States. Now, to avoid the anti-competitiveness of that, it was obviously putting our firms at a disadvantage. We instituted a system of deferral, which said we're not going to pay that second layer of tax until you actually bring the money back from Brazil. What that did was it allowed the US firm to remain competitive by not bringing the money back, but it ensured that we had trillions of dollars parked offshore, unavailable for investment in efficient fashion in the United States. And again, was another form of the disadvantage our corporate tax had produced. The final implication of that was that if there ever was a merger or acquisition across borders between a German and a US firm in this example, anyone who ran the numbers knew that the headquarters had to end up in Germany, or more generally, the headquarters ended up outside the United States. And this was the reason why the New York Stock Exchange, the iconic symbol of American capitalism, is actually headquartered in the Netherlands for tax purposes. And that was the damage that we were doing to ourselves with our corporate code. Those who were on the Hill at the time remember annual exodus of US headquarters. In the decade prior to the 2017 reforms, we lost about 100 major headquarters. We had these pitched political battles over Benedict Arnold firms. And since the 2017 reforms, we have lost exactly 0 headquarters. There was one firm that was in the process of leaving when the law was passed. It has since come back. So this has been an enormous improvement in the efficiency of our tax code and the competitiveness of our large multinational corporations to do the things that are proposed in the administration's proposals, or even what we're seeing out of Ways and Means, which is to go back to nearly the highest corporate tax rate, third from the top in the OECD, and to extend more the taxation of global income, is to move back toward the system that had generated so much in the way of losses to the United States. And those losses typically aren't visited on the executives of those firms who retain their jobs. Those losses are visited on the rank and file and the workers in those firms. And so these are really important steps in the wrong direction from the point of view of US international competitiveness, and something that I'm deeply concerned about. They also generally make the economy less efficient because we misuse capital, right? The corporate tax rate is in the end a tax on the return to capital that's invested in the corporate sector. That has 2 kinds of impacts on the operation of the economy. The first is that if you just do something to the corporations, you change the incentive to be a corporation versus being a pass-through entity like an S corp or a limited liability corporation or a partnership, something like that. So you're changing how people organize their businesses strictly for tax purposes, and those incentives will be very strong and lead to a lot of wasteful spending that only lawyers will love as we reshuffle the organizational forms in the United States. They also change where the capital goes. Capital-intensive industries will bear higher burdens. The capital will flow to other places, and we will be allocating the dollars that people save and try to have for their retirement on the basis of tax considerations, not on the basis of the greatest rate of return, which would give them the highest standard of living in retirement. So we're going to interfere with the basic objectives, which are to save for the future and generate some prosperity. Those are big impacts on the economy from these kinds of increases in the corporate rate. And when you hear modeling results that say, oh, we're going to have lower after-tax incomes, that's a testimony to the fact that we're using our resources less effectively, and it's due to the tax code, and it's an avoidable error. This is shooting yourself in the foot from an economic policy point of view. We don't want to do that. A quick reminder of one of the things that Erica pointed out, which is that as these mechanisms play out over time, the burden gets shifted from the person who sends in the check. So maybe I got the dividends and I have to put it on my return and send in my check, to less capital accumulation, less growth in productivity, less growth in real wages, and thus a lower standard of living for the workers in the economy. And it gets shifted from the owner of the capital elsewhere, largely onto workers. An extreme version of this, which we did at the American Action Forum about a year ago, is we took seriously the proposals by Bernie Sanders and Elizabeth Warren about wealth taxation. You remember those? They were just a couple cents on a dollar, only on the richest Americans. Well, if you put those in place and let the dynamics play out, you learn that 60 cents out of every dollar of wealth taxes gets paid by workers in the form of lower wages. And so instead of a tiny tax on an elite of Americans, we have a substantial burden on the average rank and file worker. And that's the kind of thing that is at odds with the rhetoric of what you're hearing. These taxes would have exactly the same kind of implications. Third thing you usually judge a tax code on, its efficiency, who pays the tax, is its complexity. And I'm pleased to see that the Ways and Means Committee avoided adding a second tax on book income. Taxable income contains lots of tax policy objectives. So, for example, there are going to be credits in the Ways and Means proposal for green energy and electrical vehicles and things like that. That's a policy objective. It reduces firms' taxes. Book income does not recognize those tax incentives. It's an accounting standard. And thus, even if a firm is doing what the Congress in its wisdom has decided it wants that firm to do, it will be taxed more heavily because the book income doesn't reflect those tax incentives, whether it's deductibility of investment or green energy credits or any of a variety of things that we want firms to recognize. Book income is also a concept that does not pay attention to just a single year, like a tax year. It's a concept that's about discounting the future and all of the income that will come from a capital investment. So the matching of book income, which is this multi-year concept, to a single tax year doesn't make a lot of sense. And it's going to produce a tremendous amount of wasteful administrative effort on the part of both firms in complying and then the IRS in checking whether they've complied correctly and enforcing the code. So that's a bad idea, and it should not come back in the Senate. It's worth keeping an eye on that. So let me close with the notion that these taxes are going to be paired with some spending programs. In the aftermath of the election, I used to sort of end up across from Jason Furman or an Austin Goolsbee or any number of prominent Democratic economists, and I would say, look, can't we just agree that these taxes are a bad idea and they're going to hurt the outlook for the U.S. economy? And they'd say, oh, no, Doug. It's true that we have some concerns about taxes, but this money is going to be spent on things that are so good that we're going to grow, and it's going to be fantastic. So I've took them at their word, and I commissioned a study using a model that's essentially what the Joint Committee on Taxation would use to look at the macroeconomic impacts of a tax proposal. And we did exactly what they claimed they were going to do. We raised the taxes as specified in the Build Back Better plan. And then we took all of that tax revenue, trillions of dollars, and had the model spend it exclusively on very productive infrastructure, roads, bridges, ports, things like that, that the literature identifies as having long-run productivity impacts. So trillions of dollars of bad news, trillions of dollars of supposed good news, the net effect, a negative for the economy. It is simply the case that the productive investments in the public sector have a lower return than those in the private sector. So as you move the capital across the line with the tax code, you lose as a nation. And we would lose if we did this. I'll just point out that no one believes the actual spending plans we're seeing coming out of the administration and Ways and Means are exclusively on highly productive hard infrastructure. They include all sorts of social programs and transfers. So the net impact is going to be even more negative. And no one should be fooled by the fact that they're somehow included in this broader reconciliation package that there's good news for the economy there. That's a very misleading depiction of what's going on. It also, I'll point out, suggests that this notion that they're going to dynamically score this and get an extra $600 billion is a fantasy of some sort. No one in their right mind would dynamically score this bill because it will be a net negative and they will lose revenue in the process. So let me close there, pass the baton, and we can get to the questions.
Great, thank you. Thank you both very much. Very, very interesting stuff there. You covered a lot of material. Um, Doug, I want to start with you. You've got a lot of years of experience here in the policy world, particularly in fiscal policy, and as CBO director. I'm trying to. I have a sense that you may have been the CBO director the last time we had a balanced budget, or close to it.
Right after that.
Okay, so okay.
All downhill on my watch.
Okay, yeah, that was truly ancient history. So we're talking 20 something years ago was the last time we had a balanced budget. Given your experience, following these negotiations over the last 20 years plus in the budget world, how do the current proposals on the corporate side compare to that long history, and then on the spending side, how does that compare? And how is our these proposals treat debt and deficits and those sorts of antiquated ideas,
Sure.
and how is it going forward? What do you think about the trajectory of the national debt and the sustainability of these the corporate tax revenue as a way to cover significant spending programs? What are your thoughts there?
So in order, the left is fond of saying, well, the corporate tax doesn't raise near the revenue it used to. It used to be a larger percentage of GDP, a larger percentage of federal revenues, and we need to go back to that. And the last sentence in that is a real non sequitur, because you can't go back to that. When we came out of World War II, the US was essentially a global monopolist in manufacturing. Most of the industrial world was literally in ruins. And with no competition, it was much easier to sustain higher rates because the profits underneath there accrued to the US exclusively. That's not the world we're in. And we can't go back to that world. As we've tried to stress in this webinar, the US is at a competitive disadvantage in many cases already. And to try to go back to that world is to essentially make it impossible for our firms to compete. We shouldn't try. So that's an important thing to remember about these and thinking about the historical context. Second thing that you hear is that, well, this is all paid for. You've heard that a lot about this. We're going to raise taxes to pay for these spending programs. Well, point number one on the proposed spending programs, if you take the programs as specified in the Biden budget, that budget has the highest 10-year federal spending as a fraction of our economy, GDP, in the history of the country. Not outside of World War II or anything. It's the highest 10-year spending in the history of the country. It is a revolutionary change in the scale and the scope of federal involvement in the economy. And the Build Back Better Act reflects that objective. It is an enormous bill. It is also has tremendous scope, from clean energy and climate issues to a huge expansion of the social safety net to some pro-unionization efforts, education. I could go on and on. This is just a dramatic effort, and it's not paid for. What they do is they have permanent increases in taxes to pay for several years of each of these programs, but they are sunset with various cliffs, because in fact, if they all went on permanently, they would create larger deficits. And so this is not a balanced budget paid for effort. This is a big increase in the structural deficit in the United States and accelerates the unsustainable accumulation of debt that we're already experiencing. And I would emphasize that it does that with a big expansion in the social safety net, even though the existing social safety net, Medicare in 4 years, Social Security in under 10, is already in financial trouble and will have to be reformed in order to survive. So instead of fixing the problems in the things people rely on right now, they're ignoring those and moving ahead and creating new problems in things that will be need to be renewed in the future. And so that's to me an irresponsible act from the point of view of the social safety net and being a good trustee of the people's resources. And the last thing is, we came into the pandemic with an unsustainable fiscal trajectory. We spent an enormous amount of money in the pandemic, and the debt jumped up so that it's now the highest level relative to the economy, GDP, in the history of the country. And now it is still on an unsustainable trajectory. Even if we did nothing, to do this is to make it even worse and to more rapidly accelerate that moment where we simply have to get something done in order to simply stabilize debt relative to GDP. Again, it's hard for me to defend that. This is something that's portrayed as costless, but it's not. If you go back to one of my comments earlier, the whole point of the debt is to get resources into the government sector. It's to make the government the centerpiece of economic activity, but the government is a low return operation, and you're taking the money from a high return operation, the private sector, and you're thus at every time you take a dollar across that line, you diminish the future. And so we're undercutting growth in the standard of living for the next generations and beyond. That translates into less capacity to spread our values around the globe, defend our country. It is a really dangerous thing to be doing, and it undercuts us fiscally. It's not particularly obvious in the moment because it happens a little bit every year, and it's the cumulative impact that you need to be worried about. And I'm quite worried that it's being dismissed so casually. And then I'll close with, you always hear people saying things like, hey, look at Japan, there's tons of debt, don't worry about it. Well, just because you're not in a crisis doesn't mean you're getting an A. I don't want to be Japan. I don't want to get a D. We can do better than that.
That's right. They started calling that, I think, in about 2000, the lost decade, and I think now they're up to three lost decades in Japan. Yeah, we want to avoid that. Erica, following up on that, and related, if you have any comments on that bigger question of debt deficits and how do we pay for all the spending? What does our modeling indicate about the major plans that have been specified by the White House and the Ways and Means Committee in terms of the impact on the deficit, how that impacts GNP, our measure of American incomes in our modeling, and then if you could also comment about the sort of basic question of corporate tax, the corporate tax as a major revenue source. How reliable is it? How much revenue can be generated there? And what about alternative sources, payroll taxes, for instance, that are a huge revenue source currently, about a much larger, about at least 3 times larger currently than corporate tax revenue in the US and in every country. Payroll taxes are a major source of revenue. And the payroll taxes have historically been used to pay for the major entitlement programs, Social Security being the first, and then Medicare and Medicaid. And what we're seeing here is a completely different approach, attempting to introduce new entitlement programs such as paid family and medical leave without the corresponding pay-fors that actually generate a lot of revenue, such as payroll taxes. What are your thoughts there, Erica?
Yeah, so first, addressing the sustainability issue, I think one of the best examples of that is how much revenue the corporate income tax increase raises, just the rate increase alone, versus the cost of a temporary expansion in the child tax credit. So we've estimated that if the child tax credit was expanded permanently, as it is in 2021, so the expansion in the child tax credit of the larger amounts, the even larger amounts for younger children, and including the full structure in 2021, making that permanent would cost more than $1.5 trillion over 10 years. Raising the corporate tax rate, as the Ways and Means proposal does, to 26.5% wouldn't even pay for half of that. So that's why we're seeing the expanded child tax credit only extended through 2025. And there are a number of things like this within the proposal. So it's not sustainable. And I think part of the reason is that the tax increases that would be required to actually pay for all of these things are not palatable to people. So if we compare to a country like Denmark or other Scandinavian countries that have many of these social programs like paid family leave, like tuition-free college, like universal pre-K. They fund those with very broad income and payroll taxes so that people making about the average level of income pay the top marginal tax rates on their income. Here in the United States, we have an extremely progressive income tax, and we're trying to rely on that to a further extent and to corporate income taxes to pay these, and it's not enough money to cover it. So I think all of those go together to say that this isn't sustainable, and that it probably isn't, because I don't think there's a willingness from lawmakers to increase payroll taxes or to look at a broad-based consumption tax to fund these proposals. So some alternatives, like I think that was one of your questions, what are the alternatives? With any tax increase, you have trade-offs in terms of its effect on economic output, its effect on the distribution of the tax burden, and how much revenue it can generate. Unfortunately, the administration and lawmakers are choosing some of the most economically harmful ways to finance their spending through reliance on corporate and international tax for about 2/3 to 3/4 of the revenue they're going to generate. Instead, they could look at things like user fees to finance the infrastructure, broad-based consumption taxes, or even eliminating provisions in the current tax code that are costly and distortive, like the deduction for state and local taxes paid. Eliminating things like those and broadening the tax base could raise significant amounts of revenue without the same harmful trade-offs that we see with corporate income taxes. And then on the distributional front, there are ways to structure these consumption taxes in a progressive manner, given that the distribution is a large concern of lawmakers. And you can do that while still minimizing these harmful effects. On our modeling of the Biden administration proposals, we found something similar to Doug. We took a look at the entirety of the fiscal year 2022 proposals, including the spending and the spending on hard infrastructure, which would have a positive economic benefit. And we found a similar result, that it's a net negative for the economy because the costs associated with these harmful taxes are more than the benefits that you get from this new spending. And to the extent that things are deficit financed or have an impact on how much Americans save, we will see a larger reduction in national income as measured by GNP than we will in national output as measured by GDP. And that's through the effect on deficits and through the effect of foreigners coming in and making these investments that we no longer make. So the returns to those investments flow to foreign savers rather than savers here, so that our incomes fall more than our output. And that is something that we've found across all of our proposals, that the effect on American incomes is a greater negative effect than on output.
Great. Thank you very much. So related to this, this topic here of the corporate tax and how much revenue can be generated there, you both touched on the topic of profit shifting, U.S. companies shifting their profits, underreporting their profits, shifting them abroad, shifting business forms. We've seen the pass-through business sector grow dramatically over the last 20 or 30 years in response to a relatively high corporate tax rate. What does that, I'll start with you, Erica. What do we find in our modeling at Tax Foundation about these proposals, the recent proposals from the House Ways and Means Committee and the Biden administration? How would they impact profit shifting? And then turn it to Doug, if you can give us some sort of general sense of, the experience of the U.S. and other countries in reducing corporate taxes over the last 40 years. Has been a steady trend lower, as you mentioned, a so-called race to the bottom, but it's more like a race to the 20s. What has happened to corporate tax revenue in those places that have reduced their corporate tax rates? Go ahead, Erica, if you could start.
Yeah, so the administration and lawmakers tend to make this claim that raising tax rates on foreign income is going to curtail profit shifting. But what they're missing in that claim, the key incentive for profit shifting is not just the tax rate on foreign income, but it's actually the tax rate differential between income that a corporation books abroad and income that they book in the US. So if you hold everything else equal, higher taxes on foreign income would reduce incentives to shift profits, but we're not holding everything else equal. All of these plans change other elements of the domestic corporate tax structure. So raising the corporate tax rate, reducing the FDII deduction strengthens the incentive to shift profits. So on net, under both the proposals from the Biden administration, as well as the proposal from House Ways and Means Committee, we find that it increases the incentive to shift profits abroad because the increase in income booked in the United States through the changes to FDII and through the higher corporate income tax rate domestically offset the effect of increasing taxes on foreign earnings to the extent that the net effect is an increase in profit shifting. And then on the question of business tax collections and are they out of sync with norm, have our business tax collections fallen dramatically? I think, Will, you mentioned a key concept that's often missed there is that the United States has a uniquely large size pass-through sector where a lot of our business takes the form of a pass-through business like an LLC or a partnership or sole proprietorship or an S corporation. That income is recognized in the individual tax system, not the corporate tax system. So after reforms in the 1980s, we saw a significant increase in the number of pass-through businesses so that business tax collections are not just collected through the corporate tax system, but also the individual tax system. And when you look at those combined business tax collections from both types of businesses as a share of GDP, we're actually well within the historical norm, even after the 2017 tax changes. So I think context there, looking at both types of businesses, not just C corporations, when so many have shifted form to pass-through sector, is just crucial for that conversation. You're missing a very important element if you're leaving out the pass-through sector.
Great.
Let me emphasize that point because it's a really important one that gets missed a lot. It's not just a substantial part of business income, it's the majority of business income. More is reported on individual returns than on C corporation returns. And other countries don't have that. And so comparisons across countries that ignore that fact are very misleading. More generally, as you pointed out, we don't have a race to a zero corporate rate, even abroad. We've had reductions in corporate rates as other countries, notably European countries, realized that their large multinational companies were facing really strong international competition, and they responded to it and lowered rates. But they didn't lower revenues dramatically. We have the same fraction of either the overall revenues or overall GDP that we had before. They developed more efficient tax systems to collect that revenue, and that was a beneficial development and one that we should join in. I want to have a race to the most efficient tax code. That's a perfectly fine race to have, and that's really what we've seen. On the profit shifting, it's important to remember that as much as I love taxes and as much as Erica might love to talk about taxes, profits are located around the globe basically because that's where the markets are, not because of tax purposes. The bulk of the organization of US multinationals or other multinationals has to do with market access, has to do with transportation costs, has to do with the economics of their business, not the federal tax code. The federal tax code is the last consideration that comes up at the end of the day and can have some influence, but its influence is often badly overstated. If you think about what we did in 2017, we went from a code that had big incentives to keep the profits abroad. I mean, literally, it wasn't so much shifting, just we'd never seen them. And we made the code much more inviting for US firms to have things in the US, bring things back to the US, and have foreign investors invest in the US. All of that was directionally exactly the right way to go. And this is now going back the other way. I think what they're missing in this discussion of profit shifting is the single greatest profit shift is moving the headquarters out of the US. That's taken all the profits and going elsewhere with them. And that's what we're inviting again. And I think that kind of profit shifting, we really do want to avoid.
Right. Okay. Thanks very much. So let's turn to some of the nitty-gritty policies that have been discussed in just the last couple of weeks. As mentioned, we've been pouring through pages of summary documents of the House Ways and Means proposals, and a lot of it is describing credits, lots and lots of tax credits for business as well as individuals. But on the business side, we have a lot of green energy credits, as well as provisions that are meant to penalize the fossil fuel industry. So for instance, sweeping the foreign income of U.S. oil and gas companies into the GILTI regime, and other, the Biden administration has proposed to remove certain elements of the tax code that directly affect the fossil fuel industry, such as intangible expensing for intangible drilling costs. This has been cast as an approach to environmental policy, an attempt to deal with climate change and other concerns about the environment. What are some of the alternative approaches there? I'll start with you, Erica, such as a carbon tax. And what sort of results might we get from a carbon tax approach, or even a gas tax, raising the gas tax? What's so bad about a carbon tax type approach, or what's so good? Go ahead.
Yeah, I think if just looking big picture, if this is supposed to be a solution to climate change through the tax code, it's about the most inefficient way that you could try to come up with a solution for climate change in the tax code. There are just a ton of tax credits for a variety of green energy type initiatives or investments. So plug-in electric vehicles, e-bicycles, commuting benefits for riding your bike to work, energy efficient buildings for a commercial deduction and an individual deduction. Just you can go down the line. And we already know that these are really inefficient provisions. They don't necessarily incentivize new investment. They may incentivize switching from one type of technology to another. There are a number of problems with the way these exist in the current tax code. And the Ways and Means proposal kind of doubles down on these problems by not only introducing environmental goals, but also introducing job goals into these green energy tax provisions by including prevailing wage requirements, apprenticeship requirements, just a number of complexities that are going to further make these inefficient. The other option, if you wanted a tax solution to the environmental issues that we have today, would be to put a price on carbon with a carbon tax. That would be sort of technology neutral, and that you wouldn't have to see if you qualify for a tax credit for this type of thing or this type of thing. It would allow the market to take care of this and come up with efficient solutions by pricing the externality of carbon emissions. I think one of the concerns with this is violating the pledge, the $400,000 pledge. A carbon tax would have a regressive impact that could be offset with a dividend or expansions and tax credits to offset the regressivity. But it also just brings up an interesting point that a carbon tax might violate the pledge for these distributional reasons, but the corporate tax doesn't. And another comparison like that is that there have been there's a tobacco tax and e-cigarette tax increase in the Ways and Means proposal, which we know will have a regressive impact. But because of some of the arguments that have been given, or because of the beneficial health outcomes from the tobacco taxes, it's okay that the tax element would be regressive. Well, the same argument should apply if we're addressing climate change through a carbon tax. The beneficial environmental things that would happen through a carbon tax could be said to. So it's kind of apples and oranges when we're talking about the pledge and why something like the relative efficiency of a carbon tax hasn't been included here. It would also raise a lot of revenue, which could help pay for some of these other programs. I think that kind of wraps up what's happening on the green energy front. It's very inefficient.
Okay, Doug?
Yeah, at the biggest picture, the 50,000 foot level, the administration's approach to climate is wrongheaded in its focus on dictating fuel inputs and demonizing particular sources of energy. You should not care about what goes in. You should care about the emissions that come out, and your policy should be targeted on getting those emissions to the levels that are sustainable and stabilize concentrations in the atmosphere. It's very straightforward, but they're not doing that. What that says from a tax policy point of view is exactly what Eric had pointed out. You want to have a broad-based so that it's getting as much of the economy as possible. Level, everyone pays the same tax for the same polluting activity, and thus provide the incentives to be able to avoid that tax any way you can, either by minimizing the amount of energy that goes in absolute terms, by changing the fuel mix, innovating a new technology, changing the nature of your product. We shouldn't have a stake in, and indeed we are not well positioned to understand the kinds of responses that will be most effective. Out there in the real world, on the ground, people will make those choices. The ones who do it successfully will succeed. That's how our economy has always worked. They will sell their products and they will pay little tax. So that's what should be done. This array of green energy credits is a terribly inefficient way to go. And as Erica pointed out, it's been mixed in with other objectives as well. I mean, I think I don't know which I find more ludicrous: the notion that we're going to have an operations and maintenance broadband tax credit that's available to state and local governments who are non-taxable entities. Okay, so explain that one to me. So that's clearly going into some other objectives. Or we're going to have an extra electric vehicle tax credit if the vehicle was made with union labor. And that's obviously has nothing to do with the environment and is generating yet a more tortured and inefficient tax code.
Okay, I think we got it. We've got switching topics in the last 5 minutes here. Let's talk about this, where this might end up. The legislative sausage making process is hard to predict, but try to put your forecasting cap on, political forecasting, and tell us what you think might happen at, by the end of this year, let's say. Where might the corporate rate end up, and where might the international tax system that applies to U.S. multinationals end up, and what might happen to certain incentives such as expensing for R&D that is part of this year's tax code and is due to expire at the end of the year, and what might happen to some of the other ideas that are floating around, such as the minimum tax on book income. Erica, if you could start us out.
Yeah, I expect, timeline wise, I think probably next week we'll see movement in House Rules Committee, and then I'm not sure what's going to go on with the Senate and whether they'll need to conference it or whether they'll be able to work out their agreements beforehand. So process still a little muddled on that. I think as far as the policy outcomes, I think the corporate rate will probably be 25%. I think we may see the House proposals on the structure for international provisions prevail, but maybe we'll see some movings in the rate towards what the Biden administration has outlined. I think this isn't business side, but I think we'll see something on the state and local tax deduction get added back in. I don't think there's a way that this passes without some sort of change to the SALT cap over the next few years before it's set to expire. And then I was pleasantly surprised to see the Ways and Means Committee include at least a delay for the research and development expenses to be amortized. Ideally, that would be permanent, and they would take care of that and not make that another extender that has to continually be dealt with. But at least they're, I guess, kicking the can down the road rather than allowing that that switch to take effect. Hopefully that stays in. But overall, this, I think, moves in the wrong direction in terms of rates and in terms of structure for international taxes, but maybe it can be moderated somewhat even more from the original goalposts that the Biden administration outlined.
Okay, Doug?
I think I largely agree with Erica. I would point out that there's just no way on God's green earth that the Senate Finance Committee will take something that Ways and Means created and say this is fine and not touch it. It's never happened. It won't happen. And that means that there will have to be 3 votes, one in the House, it'll go over to the Senate, get changed, it'll have to come back to the House. And so in thinking about what the Senate will do, they don't have the luxury of doing what they'd like. I think they'd be much more aggressive than we saw out of the Ways and Means Committee on some of these corporate provisions and raise more revenue that way, go for something like a book income tax. I think Chairman Wyden's much more open to those kinds of things than we saw in the House. But since it has to go back to the House and they have to run the table 3 times, not lose votes, that's going to moderate those instincts on the Senate side. And so we'll see something closer to Ways and Means than we otherwise might have thought.
Interesting. Okay. Well, we're at the top of the hour, and we've gotten a lot accomplished in this hour. So really appreciate both of our panelists here, Doug Holtz-Eakin and Erica York. As mentioned at the beginning, this has been recorded for everyone's later viewing, if they so choose, and it will be eventually available on our website. And feel free to reach out to any of us here at Tax Foundation, as well as Doug Holtz-Eakin, for expertise on the upcoming negotiations on tax and spending policy. So with that, I'm going to sign off and see you next time. Take care.
Thank you, Will. Thank you, Erica.
Thank
Bye-bye.
you.